Hello and welcome to Week in Markets. Today I'm joined by Sebastian Mackay, Investment Director, and we're going to talk through the key events of this week, ranging from financial markets, but then looking at some of the data coming from the UK, but also the US. If we just start with markets, Seb, we've seen global equities continue to grind higher, led by US equities, up just over 4% this week, but also seeing strength in Europe, UK, which actually puts year-to-date returns on pretty healthy levels. Can you just perhaps discuss what's continuing to see equity markets grind higher?
I think it's a combination of things. Particularly, I suppose the surprise in the last few weeks has just been how well the US in particular has performed. And I think that's due to a couple of factors. So obviously the backtracking on tariffs that Trump has been undertaking in the last couple of weeks, and particularly the climb down on tariffs with China is a major kind of confirmation of what the market had already started to sniff out, that the direction of travel on tariffs, having come in hard initially, was likely to be backtracking. But I think some of the results coming from companies, and particularly tech companies, has also perhaps confirmed that concerns about the tech bubble popping, there might be some kind of correction going on, but maybe it's not as dramatic and immediate as some had feared early in the year.
Yeah, so I think it's, if we go back 4 or 6 weeks ago, we were doing these videos. We were very much talking about the importance of, having a long-term horizon, staying invested, believing in diversification and active management to help navigate through these environments. And I think a lot of those points have really come through, given the rebound that we have. We've almost retraced in most markets. The Liberation Day falls, and we're back to new all-time highs in somewhere like Germany. I suppose, have we seen all assets kind of rewind? So like we've seen equities up, but gold had been doing well. Has that continued to do well? Has the dollar continued to? We've seen a reverse in the dollar?
Yeah. Well, gold had been a clear beneficiary of the chaos created by Liberation Day and the reciprocal tariffs. And as we've seen tariffs wound back and fears of recession wound back, gold has fallen a little bit. So it's a few percent off the peak that it reached some weeks ago. I think on the dollar has recovered a little bit, having been very weak a few weeks ago, but it hasn't really recovered in tandem with the recovery in US equities. And I think that's because that's probably a lasting legacy of this Trump administration's policy, is that they would like to see a weaker dollar. They do feel that the reserve status of the US dollar has unfairly made US manufacturing less competitive. And so, in a way, some of the winding back of tariffs is implicitly in exchange for other countries accepting their currencies appreciating a little bit against the dollar.
Yeah, excellent. If we think about the impact of tariffs, the perception is it's bad for growth and it's bad for inflation. So higher inflation, lower growth. And if we look at business survey data that has been coming through, it's certainly shown that inflation expectations near term have gone up, and businesses and households have been more downbeat about expectations going forward, whether that's hiring, investment plans. We're starting to get through actual data for April.
Yeah.
We've had a few of those. We've had retail sales this week. We've had jobless claims, inflation data.
Yeah.
Is it catching up with some of that survey data?
Not really, I would say, and I think this is often the case, that the survey data responds quite significantly to any political or market news, and then the hard data comes through and it's a bit more modest. It's true to say that most of the hard data that we're getting is probably not yet caught up with the full impact of some of the policies that have been announced. But we had, for example, retail sales data from the US for the month of April, which were, having been very strong in March, probably as people front-loaded their spending ahead of likely tariffs. They continued to decline by 0.1%, but we're probably going to get some kind of correction in that because people have front-loaded their spending. But quite an interesting piece of data was the US producer price indices, and that has within it a component that relates quite closely to retail and wholesale profit margins. And that collapsed, so that was down 1.6% on the month. And that's slightly contradictory with some of the news that we've had from independent companies. So Walmart was saying that they were probably going to have to push up prices to some extent to reflect the increase in costs. So we're still kind of trying to disentangle how severe the impact of increased costs is on companies and to what extent they will pass that through to consumers. But that producer price data suggests, at least for April, that companies they're taking the hit in profit margins rather than passing it on to consumers, which is bad news for corporate profit margins, but better news for consumers because it's not feeding through to consumer price inflation and probably gives more of a green light for the Federal Reserve to cut interest rates.
I suppose it's certainly an interesting development to look out for is how profit margins evolve, because you'd expect if profit margins are squeezed, then that would be a risk to the labour market and companies making additional layoffs. If we actually look at what is known as the jobless claims data that came out this week, so the number of people that are claiming unemployment benefits in the US, that's actually stayed relatively stable. We haven't seen any pickup there, which is a real positive.
Yeah, and I think generally companies are reluctant to lay people off because it's expensive for them to lay people off and then rehire people if it turns out that the drop in demand that they were worried about doesn't transpire. So I think that's why companies will tend to, in a situation where the environment is very uncertain, which is obviously the situation we're in now, and we don't know how many tariffs are going to stick, they're probably just waiting and seeing before they start making people redundant. And the good news that we've had in terms of tariffs being wound back probably means that they won't go through with and make people redundant. I know we're going to talk about the UK later, but anecdotally, companies in the UK, for example, are saying that even though they're faced with an increase in national insurance contributions in April and other increases in costs and the impact of tariffs, even after the UK-US trade deal, there's still a 10% blanket tariff on UK goods. The last thing they want to do, so there's a number of ways they can deal with these problems. One is increase prices. One is improve their profit. Take the hit in terms of profit margin, or improve efficiency. And the last kind of action that they can take is making people redundant, and they're most reluctant to do that. Yeah. So that's kind of good news for the labour market.
And it's similar to what we saw, I think, in 22-23, where we had a bit of an earnings recession, but we didn't see any really pickup in unemployment.
Yeah.
Okay, let's finish on the UK then. If we think about UK equities, up 1.5% this week. Year to date, they're up over 6%. Now, markets don't necessarily translate into what's happening in the economy and vice versa. So we've had UK GDP data out. So how much the economy is growing for the first quarter of this year, a little bit better than expected.
Yeah, I mean, it's quite rare that we get good economic news out of the UK these days, but a 0.7% increase quarter on quarter, and the latest month was up plus 0.2 on the month. Is a pretty good number and stronger than economists had expected. There could be a bit of a surge in spending ahead of the increase in national insurance contributions, or employers' national insurance contributions that would have come after that quarter. And some aspects of the GDP report looked a bit odd, so there was an increase in investment spending, which doesn't really tie in with surveys of investment intentions, which have been quite depressed. Maybe this is as good economic news as we're going to get for now. There's a number of headwinds to UK growth over the next 6 months or so, but for now we'll take it as it comes.
Absolutely, we'll finish on that positive tone. Well, that's everything from us today. Thank you very much for watching, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.